Welcome to The Explainer. When it comes to sustainability, we are absolutely swimming in data. But the real question is, how do we connect those abstract metrics to actual concrete financial impact? Today, we're going to dive into a framework that does exactly that. It helps turn sustainability reporting into a seriously powerful tool for creating value.
So, picture this. A company reports it's using 1.88 cubic meters of water for every ton of production. And hey, that's an improvement from last year. On the surface, that sounds pretty good, right? A definite step in the right direction.
But what does that number really mean for the business? How much money did that actually save? Does it lower their risk profile in places that are prone to drought? And how do they stack up against their competitors? To get to the bottom of those questions, we have to go way beyond just the single data point. We need to build a real financial story around it. So here's how we're going to break it down. We'll start by figuring out how to classify sustainability issues in the first place. Then we'll get into the three key dimensions that really define their financial character. And finally, we'll tie it all back to the thing that matters most: company valuation.
Okay, let's dive in. The very first, and honestly the most crucial step, is to apply a really simple filter. Are we looking at a risk, or are we looking at an opportunity? This one decision is going to set the stage for everything else that follows.
It's a really fundamental distinction. Are we talking about a threat, like, say, rising greenhouse gas emissions? Or is it an opportunity, like gaining market share because you've developed some innovative, eco-friendly products? Getting this right from the start is absolutely the first step to getting that financial clarity.
So how do you decide? Well, just ask yourself a couple of simple questions. Do higher numbers for this metric mean better revenues, more sales, or better efficiency? If the answer is yes, then you're almost certainly looking at an opportunity. Or do they point to threats, things like accidents, waste, or big regulatory fines? Well, that pretty clearly points you towards a risk.
All right, so now that we've sorted our issue into either the risk or the opportunity bucket, we need to understand its financial DNA. And we do that by looking at it through three key dimensions: likelihood, timing, and magnitude.
Remember these three words. They are the absolute key to unlocking the true financial relevance of any sustainability issue you're ever going to look at. So, let's break them down one by one.
First up, likelihood. This is all about probability. Is this a guaranteed, recurring cost that's already hitting the income statement, or is it some potential future event that we just need to get ready for?
Think about the difference between, say, a black swan event, like a massive oil spill, super low likelihood but absolutely catastrophic, and the high likelihood, totally predictable costs of rising water prices in a region that's always in a drought. Both have financial consequences for sure, but you have to manage them in completely different ways.
Next up is timing. Is this a financial hit that we need to brace for this quarter, or is it more of a long-term trend that's going to shape our strategy for the next decade? The time frame is absolutely critical for any kind of financial planning.
A product recall, for instance, has an immediate, near-term impact on this year's books. But on the other hand, the global phase-out of fossil fuels, that's a long-term trend that's going to unfold over many, many years. But believe me, its financial consequences are just as real.
And finally, we have magnitude. What's the scale of the financial impact here? Are we talking about a rounding error in the financials, or is this an existential threat to the entire business model?
Low magnitude impacts, things like cost savings from being more efficient, they're important because, they really add up over time. But high magnitude impacts, things like having your assets become worthless because of new carbon regulations or losing your social license to operate, those can be just catastrophic. And here's the real key. These three dimensions, they're not just some checklist you run through. They combine to create a totally unique financial signature for every single sustainability issue. A low probability, high impact risk demands a completely different strategy than a high probability, low impact trend does.
Okay, so now let's pull these three dimensions together into two simple, really powerful categories that make this whole framework even more practical. We're talking about acute and progressive impacts.
I love this table because it just summarizes our framework so elegantly. Think of acute impacts like lightning strikes. They're low likelihood but high magnitude events, like an oil spill. Progressive impacts, on the other hand, are more like a rising tide. High likelihood, ongoing forces that just gradually reshape the financial landscape, things like shifting consumer preferences towards sustainable products.
Okay, let's make this really concrete with a real-world example: data security. Let's imagine we're comparing 4 different companies, all in the same industry.
First, we have Company A. They're experiencing this slow erosion of value. It's a classic progressive impact, really. It's like a death by 1,000 cuts, from ongoing operational costs, fixing things, and just minor hits to their reputation. Now, Company B has the same frequency problem as Company A, but the higher magnitude of each breach tells you there's a much more serious, systematic failure in how they manage risk. Those progressive costs are piling up way faster. Company C is our lightning strike. It's a sudden, acute event that triggers massive, one-time costs from fines and lawsuits. It can seriously damage the company's reputation and its stock price in the very short term. And finally, Company D. This one shows us that even what looks like good performance needs a closer look. I mean, their numbers look fantastic, but what's the context? Are they just in a less risky part of the market, or have they just been lucky? We need more information to really understand their true risk exposure. So how can you take this way of thinking and apply it systematically to any sustainability metric you run into, whether you see it in a company report or you hear it in an analyst briefing? Well, here's a practical, 4-step process. First, hunt for the evidence of financial impact. Then figure out if you're dealing with hard numbers, quantitative data, or a qualitative story. From there, you can classify it as acute or progressive. And finally, you assess its timing and plug it into your financial forecast. And I want to be really clear, this whole characterization process, it isn't just some kind of academic exercise. It is the essential, non-negotiable first step for any credible financial valuation. This framework translates directly into the language of financial modeling. I mean, for anyone doing a discounted cash flow analysis, this is gold. A progressive impact is going to change your long-term expense forecasts. A really severe acute risk that could easily increase the discount rate you apply to all future cash flows. This is exactly how sustainability gets priced into a company's valuation. So, to wrap it all up, by applying this framework, you transform a sustainability metric from just an isolated, lonely data point into a crucial, decision-relevant input for serious financial analysis. So the next time you see a sustainability metric, don't just ask, what is it? Ask, what is its financial character? Because when you do that, you're not just reporting on what happened in the past, you are actively shaping the financial future of your organization. And that is the real power of this framework.